Welcome to this special edition of the FarrCast. From time to time, we have conversations with our guests that go beyond the usual segment length, but are so interesting, so important, that we want to share the full, unedited conversation with our listeners. The following segment with Dr. Jeffrey Lacker, former president of the Richmond Federal Reserve, recorded on November 2nd, 2023, is one such example. Dr. Lacker was known as one of the more hawkish members when he served on the Federal Reserve Open Market Committee, and Jeff gives us a great explanation of the risks facing the Fed now, what he would do differently to manage those risks, and how Powell's path might just work. Now here is Dr. Jeffrey Lacker, along with your host, Michael Farr.
Welcome back to the FarrCast. I am Michael Farr. It's November the 2nd. The Fed announced yesterday that they would leave rates unchanged, that they're not sure that they're at the right level yet. They're not sure that monetary policy is sufficiently restrictive yet to ultimately tame inflation, but for the time being, they're going to sit on their hands. That's exactly what the markets expected them to say, and yet the markets rallied, went straight up. All of those people desperate to sell last week and drove stock prices lower are seemingly desperate to buy this week, and they're buoyed by some decent earnings, as Jim Lebenthal was telling us in the first segment, beating expectations. There's some good news out there, not to mention GDP growth, positive even net of inflation. It's a real number that's positive. Jeff Lacker was on CNBC yesterday morning offering a more cautionary, hawkish tone to what he thought we might hear from the meeting. Not what he thought we might hear. He actually said that he thought what we should hear should be more hawkish than what he thought we're going to hear. And in fact, I think he probably still feels that way. But Dr. Jeffrey Lacker was president of the Federal Reserve Bank of Richmond, Virginia, a professor of economics at several amazingly brilliant institutions. And he's amazingly brilliant and a wonderful friend of mine now for many years. You know, Jeff, 15 years ago, you and I were in Israel together. 2008,
That's right.
15 years.
That's right. My first trip. Still indelibly etched in my mind and top of mind these days.
Isn't it? Yes, I remember every bit about that trip, and I remember where I remember our visit to the Supreme Court, and I remember our visit to
Yad Vashem.
Yad Vashem. Oh, it took me hours to actually speak after we went through Yad Vashem.
Yeah.
And through the old city of Jerusalem.
Dead Sea, the Golan Heights, you're up there and you realize how small the world is and how packed together these multiple cultures are. And
even in the old city of Jerusalem, 3 or 4 different faiths and cultures would point to the same rock and claim ownership of it according to their religious narrative. And it's vitally important to my faith. No, it's vitally important to my faith. And you're thinking that rock was not above the surface where it is now 5,000 years ago. When you say it was important, it wasn't there, but it's.
No, your heart breaks thinking about what's going on over there.
And the economic impact too, Jeff, how do you think this gets resolved? And it seems as if there's no way around a humanitarian crisis. We're already in the middle of one, right? I mean, you think about over 1,000 Israelis who were slaughtered. No other way to say it, ladies and gentlemen, slaughtered. And there are Palestinians who are being slaughtered as a part of the pursuit of Hamas in Palestine. It's so awful. How do you make sense?
It's really distressing. The thing that I find kind of lacking in media coverage, I mean, there's a lot of focus on the suffering in Gaza. There's a lot of focus on the pain and trauma of the slaughter of just innocent civilian Jews, on October 7th. But in the aftermath, what should Israel do? I mean, if you think it's so objectionable, what should they do? I mean, you can't expect a state to sit by and allow a situation in which 1,000 of their people can be slaughtered with no consequence and with no effort to prevent it happening again. So Yeah,
We were
that's
not
top of
going to
mind for me.
not respond to 9/11. We were
Yeah,
going to.
for sure. I mean, what would you expect us to do? What should we do?
What should we do?
So
What should
yeah,
we do?
and it's hard. The collateral damage is heartbreaking and distressing. But yeah,
Every
tough situation.
politician in this country takes an oath to protect and defend this country and the Constitution of the United States. I mean, so
Yeah.
it is tragic. Jeff, what did you make, shifting to the Fed here?
Mhm.
What did you make? It was an excellent appearance on CNBC yesterday, by the
Well,
way.
thank you.
Yeah,
Mhm.
you're, it really is ruining your academic creds that you're getting to be such a good talking head, really,
Yeah, the key is not preparing. That's the
Well, it's worked for Lebenthal and me for years, folks. I promise. Tell us what you think. What's going on?
So I read the statement and watched the press conference, and he really doesn't want to raise rates, but they don't feel like they can admit that out loud. They don't feel like they can say it out loud. So they kept a rate increase on the table, but it's like the FOMC sitting at one end of one of those gigantic medieval banquet hall tables, like in Hogwarts or something, that seats 80,
Yes.
and they've moved rate cuts from the end they're sitting at all the way to the other end. It's about 40 yards away down the banquet hall. So it's on the table, technically speaking, but it's always a possibility. But they're not, they don't want to admit they're done. But he came as close to saying that as he possibly could. He said risks are more balanced. He basically threw the September forecast that they issued, in which a majority said that there'd be another rate increase that this year, basically threw that under the bus and saying it had decayed. And so he gave every signal he could that they're basically done for now. But as I said on the program yesterday, I think it's a mistake. You have to distinguish carefully between what they're gonna do and what they ought to do. And I tried to do that yesterday. I really think they're gonna find they need to raise rates again next year, and resume a campaign.
Tell us why. Tell us why.
Well, so they've gotten a lot of mileage out of a couple of things. The inflation rate is measured by a 12-month percent change, has come down a lot in the last 6 months. So there's two things. They got two good inflation numbers over the summer, June and July. And a lot of that was used cars and airlines fees and stuff. But then the other thing is that a bunch of big increases last year in the middle of the year are rolling off. And so what you're seeing is the emergence of a new trend. If you look at just the month over month numbers, the trend over the last 6 to 8 months isn't really well defined. I mean, it's not a real clear downward path. The last 2 months have been not so favorable. August and September have been pretty strong core inflation numbers, above 3. And so they, they're counting on this 12-month number having come down. Well, it's not clear how much momentum there is, how much more disinflation momentum there is. It just isn't clear at all. And it looks like inflation's settling in somewhere between 3 and 4%.
My friend Jim
like the run rate
Lebenthal in the first Jim Lebenthal in the first segment said, if you remove shelter costs, we're really at about 2%, and that's such a lagging number that it's not going to be driving things forward. What do you think about that?
Well, it's a real it's a real thing people pay for. And besides, the Fed didn't say it's targeting inflation X housing. It said it's targeting inflation. So they've got they're going to have a credibility problem the longer it goes on at 3.
The other thing Lebenthal said was if they continue to increase rates, they're going to cause this spike in unemployment. And we have so many in this country suffering and so many people losing jobs that there's still a tragedy among the most vulnerable that continues to unfold. Will the Fed sit at the table and allow that to happen, given the fact Jim said, given their moral conscience, because he has one. I, of course, am questionable, and I suggested, that they are being so politicized and criticized for everything they do. Couldn't they afford to do it?
If you go back to the beginning of the year, the outlook was that there's a big recession, a sizable risk of recession and a spike in unemployment. And I think that's when and why they set course by decelerating the rate of increases, stretching it out to every other month, every other meeting rather. And now they've skipped two. I think they decided 6 months or more ago, yeah, they were going to top her out around 5.25, 5.5. But since then, real economic activity has been stronger than expected, significantly stronger than expected. The job market is tighter than they thought it would be. They thought it would be loosening up. It hasn't loosened up as much as they thought. And if you look at this in terms of two risks, you got inflation, they're a long way away from 2%. And it's not, and on the real side, you've got a fairly strong economy, stronger than expected. I mean, they're definitely at maximum employment or above. So it looks to me as if in terms of balancing the risks of the two sides of the mandate, it's a kind of way they like to frame things sometimes. They're fine on the employment side, overperforming in some sense. And on inflation, they're not there yet. So why not take on more risk in order to do more do more good in terms of reducing inflation? That's kind of my perspective right now.
That was the argument actually I made back to Jim, was the higher prices, if they're not taming inflation, can do as much harm to those most vulnerable as can the loss of jobs. And it is that balance, and then it becomes politicized. So we'll watch that. But of course, as I've said for years on the FarrCast, listen to Lebenthal. Listen to Lebenthal. He pays attention to this stuff. Jeff, would you do something different were you on the Fed right now? I mean, I hear you saying you think they might have to do more later, but do you think it's a mistake to watch now? I don't.
So where they are now is kind of the consequence of a bunch of communication steps they've taken over the last 6 months. I wouldn't have tapered off. I would have headed towards 6 or 6.5 by now.
Yeah.
And I think financial markets could withstand it, and I think they'd be better positioned. I think growth would be maybe a little bit lower in the next half year, and they'd make more progress on inflation.
Here we are at 5.25. Would you sit on your hands now too? You're Fed chairman,
No.
Jay Powell, get rid of him. Would you sit on your hands right now?
No.
For months?
No, I'd
Okay.
signal another, starting now. You put me in the position now, I'd start signaling about an increase in December, and leave the door open and get people focused on, the inflation numbers as they come in and respond to them. I mean, in some sense, the Fed's here at 5.25 and 5.5, which is where they said they were going to end up 6 months ago.
Yeah.
But yet the data's come in different than they expected. And so it doesn't seem like they're as data dependent as, they say.
Do I need to worry about all of this debt? Janet Yellen and her 112 billion yesterday, which was down from 114 billion. Yippee, Janet. But 680 billion to follow over the next 2 months, and 814 billion in the first quarter, and the deficits are still rising. And I've got 5% interest rates out there at the cost of this new debt, and we're not seeing much of a huge appetite for a lot of these auctions. And certainly the Fed's no longer a buyer. They've been a net seller here lately. Do I worry about it? And what do I think about the Fed as a net seller? And is Janet Yellen and all of this supply with the fiscal side of the house going to do the Fed's job for them?
That's a really good question.
Wow. Hey, Harry, I got one today. One. Put me down.
Really good question. Yeah. I wish we'd gotten to that yesterday on CNBC. I was surprised a couple of weeks ago when a bunch of Fed officials started saying that the increase in the long bond yield was going to do their work for them. I mean, 180 degrees from how the Fed has historically responded to increases in long bond yields. Historically, it's one of two things, both of which mean higher Fed funds rates. One is inflation expectations are rising. Arguably, that's probably not going on now. The second one is the deficit is driving up real interest rates. The Fed likes to talk about R star, the neutral interest rate. Well, that neutral interest rate varies over time. And when you have a government that's spending more and not taking it out in tax revenues, that's placing that's increasing the demand for current resources.
Yes.
And the way to make room in the economy for the resources they want is to get people to delay spending on other stuff. And the way to do that is to raise real interest rates. And that's the reason why real interest rates have to go up when the government runs a bigger deficit. And that's why it puts upward pressure on interest rates. And the Fed has to track that. If it doesn't track that, if it doesn't follow the long bond up, it's making policy more stimulative in a sense.
Say that again. No, whoa.
So if the neutral rate goes up,
hang on. I just want to get, if it doesn't track the long bond up, meaning if it doesn't raise these lower end interest rates to keep the curve not quite so steep,
right?
Meaning short rates too different from long rates, that's being stimulative.
Yeah.
Why and how is that stimulative?
Well,
give me the moron's explanation. Remember, I'm a moron.
Okay, so there's a rate that's neutral.
Yes.
A rate that and it's a.
What does that mean? Neutral
Well,
rate.
it means it's neither stimulative nor contractionary, and that's the benchmark that we're comparing the current Fed funds rate to.
And is that the goal for the Fed, that neutral rate?
Well, it's to bring inflation down and employment up so that it can bring rates back down to neutral. It's a rate it has to track in the long run. I mean, it's going to be forced to.
Okay.
So the policy rate's 5.5, 5.25 now, right? So if the neutral rate rises, 5.25 is now not as high relative to the neutral rate.
Okay.
So policies become less tight than it used to be.
With inflation coming down, the real rate has been going up. And there has been an argument that with inflation coming down, that rate staying tight, the real rate's been going up, and therefore markets and the trend that perhaps these rate hikes have done their job. They have curtailed demand such that that inflation's coming down, and then rates are more appropriate at these levels. That's been a big argument out there.
Sure has been, but if you look at the real federal funds rate, and you compare it in this recovery, and you compare it to the real federal funds rate in the time period from the early 80s to the mid 2000s, when the Fed was doing a pretty good job of controlling inflation and keeping it under control. The real Fed funds rate now is 2%, maybe.
Okay.
In all the other recoveries, the real Fed funds rate was 4, 5, or 7.5.
Okay, so now I'm hearing, and I can't think of the data, and I sure as hell don't have it, but I can hear Jeff Gundlach saying, "Oh, but this time it's different."
Could be. Pick your poison, put your money down, take your chances. But that's just a measure of, it's one indicator among others that, this funds rate isn't quite high enough to do the job of bringing inflation all the way down to 2%. That's how I read this evidence.
Okay, between now and next June, give us a percentage chance the Fed will have to raise rates again.
Well, so have to is a strong word, strong phrase.
How about will?
They can always will raise rates. That's better. I'd say 50. I'd say 50? At least 50 that they will raise rates.
Okay.
So he asked me a question like, what are the odds that they should raise rates between now and then? And I think that's pretty high, like 90%. So
Okay.
I think inflation's going to muddle along at 3% or 4%, somewhere in there. And I think that the disinflation, I think 6 months from now, it'll look like disinflation is stalled out.
If we don't achieve this Platonic Lacanian ideal of doing the right thing sooner, what will happen to the economy were they to leave it here? They don't raise rates. They go with the 50% odds and the other 50 where they don't do anything. What happens to the economy? Are we in trouble? Will that stop our expansion? Because we still have real economic growth. We've got a 4.9% GDP print for the third quarter. We've got, as you said, maybe 3 to 4% inflation. We still got positive economic growth.
The risk in letting inflation trundle along, in the mid threes, is that it'll erode their credibility, and people will start adapting to a higher inflation rate. In some sense, the UAW settlement is a signal of that.
Yes.
And when that happens, it's going to take more medicine to get inflation down later rather than sooner. And Jay Powell said that a bunch last year, that that it's worthwhile running the risk of a deteriorating job market in order to get inflation down now, that it's not worth it to try and do it slowly. And yet here they are now turning to doing it slowly.
Too quick. Oh, go ahead. I've got two quick.
The other thing is that they're vulnerable to shocks that send inflation up again.
Yes.
And you can imagine all sorts of disruptions that could do that.
Maybe even shocks that could take it down. Maybe shocks.
Inflation down. Yeah, it's possible, but I mean, there are limits to that, right? I mean, used car prices can't go negative, right?
Here are my two final questions. You have been thinking a recession was likely. Do you think it's still likely to happen? Number one. And number two, final question will be, and then we'll leave. At what point during the year will the Fed go quiet prior to a presidential election?
Yeah, so they're not going to do it the meeting before the vote. Probably not 2 meetings before the vote. So
July would be the last time you might hear.
July's their last chance. Yeah.
July's the last chance for the Fed. Okay. Yeah. And what about odds of a recession? You did think it was likely, didn't you?
I did. I thought that they wouldn't be able to get it down to 2 without it.
Yeah.
But in some sense, that was a contingent probability, but a contingent projection. It doesn't look like they're getting it down to 2. I mean, the strength in the economy suggests that recession risks have receded. But on the other hand, that strength is in some sense a measure of that they haven't done as much as they need to reduce spending growth.
Recession was an acceptable consequence early on in all of the Fed's commentary in order to quell inflation and tame it. Have they been able to do this without a recession? Will we still see one? I guess is really my question. Will we see one?
I think there's less of a chance of it, but I still think there is a chance. And it's going to depend on how they play their hand. I mean, if they're happy, if they're willing to countenance 3.5% inflation for a year or 2 or more, they can go by without a recession for quite a while.
That doesn't feel like an awful mistake when I hear you say that. I'm thinking, okay, 3 to 3.5%, they countenance that, and then we kind of squeak through, slide by, and we don't have a recession. Why don't I want to see that?
Well, that's what they said in 1967. And it didn't turn out so well.
It did not turn out so well. Yeah. Ladies and gentlemen, this is why we talk to Lacker. He's just so damn smart, and he has it, and he's thoughtful about it. Jeff Lacker, thank you so much for being with us on the FarrCast. Damn, do I learn a lot when I get to talk to you. And ladies and gentlemen, can you tell how much fun I have with him and how much I like this guy. I mean, that's as much fun as anything. Thanks for being with us on the FarrCast, everybody.
pleasure,
We'll be
Michael.
back again next week as we cover Wall Street, Washington, and the world. Harry Jennings and our producer, all of us at Farr Miller in Washington, thank you. Thanks. We're adding thousands of listeners. It's awesome. Please continue to share us on your social media. We'll be back next week with another FarrCast. I'm Michael Farr.
Thanks for joining us on this special edition of the FarrCast with Dr. Jeffrey Lacker, former president of the Federal Reserve Bank of Richmond, Virginia. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly on all major podcast platforms. You can listen to regular episodes this week and every week for free on Spotify, Apple Podcasts, or your favorite platform. Thanks for listening, and please share us on social media. If you have any questions, please feel free to reach out to me at hjennings@farrmiller.com. We look forward to reading all of your notes, and we try to respond to all of them. We'll be back with you next week here on the FarrCast. Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC, or any of its affiliates. Farr Miller in Washington and Hightower Advisors, LLC, or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.